Well, one, that is the first benefit is when you look at accessing equity, because remember the equity is not liquid. So let's just use the scenario. Someone purchases their home, they put 30% down. They just took 30% of liquid cash, put it into property, and I get it. Maybe that's what they needed to do to qualify. Everyone's situation is different. However, that 30%, if that was $100,000, let's say, was no longer liquid. And so having conversations or helping a borrower bridge the gap using that equity, that's the first piece. That's the very first thing that helps them, is by making a portion of their equity liquid so that they can decide what solves their needs and pain. I'm not sure how else to add to that other than the strategy is different for some. Some folks are buying investment property and they got a check for it, and yet they want to recoup their funds to go buy additional investment property, right? So almost absolutely. It's an incredible opportunity to build the gap between purchase and purchase. And I'll use investor as the scenario here. A lot of times investors, when they purchase homes, will do it cash. They'll scratch a check, for lack of a better term, and buy a home. And when they do that, they've then tied up a ton of their liquidity into now equity. And the opportunity is real to then show that investor how to get the equity back out to therefore go and purchase more or additional property. And it's a huge win there, especially when you consider doing traditional agency loans, given where rates are, and then you add to the equation loan level price adjustments, FICO score restrictions, investment lending restrictions. The HELOC typically prices considerably better than a traditional loan.